My next guest counts two of these names among his biggest holdings. Joining us now is value investor Chris Davis, chairman and portfolio manager of Davis Advisors and a director at Berkshire Hathaway. Chris, it's great to see you on a day like this. Welcome.
Oh, Kelly, it's great to be here. Thank you.
So I look at these declines, 35% or whatnot for some of the Mag 7. And I hate to ask this as a question right off the bat, but are these moments for investors to be looking at individual stocks at the broader market and thinking, okay, we've corrected enough that this is an entry point?
Well, it's a crazy thing to even use these terms like Mag 7, right? In other words, people lump businesses together, even if the underlying businesses have totally different fundamentals and different prospects. And you can think back to the Nifty 50 going back to the early 70s. That was viewed as sort of a category of stocks, the growth darlings of their era. And yet, if you looked at the next 10 years, the performance diverges dramatically. So I certainly think that it is a time to really focus on questions like resiliency, durability, valuation, and the underlying business model. And when you look at the Mag 7, there are enormous dispersions in business models, valuations, durability, prospects. So selectivity is exactly the word of the day.
Yeah, and you've got Meta, you've got Amazon. I don't see NVIDIA, Tesla. I don't see Apple as names. So like that's where you come down. Is that right?
Exactly. Each, investing is the art of the specific, and we're trying to look through at individual businesses. And we've been in a market that's been based on indexes, themes, people swinging in and out based on momentum. I think we're in a big return to really selectivity. And I think that's why we may actually see a sort of a boom in active management again. It's been sort of the whipping horse for so long relative to passive indexes, but those indexes got very concentrated, very narrow, and very richly valued. So I think you're seeing a move back to active in general, and then within active, this real selectivity to be able to look at the Mag 7 and try to pick the three that are the best position to look at 500 companies in an index and pick maybe the 5% or 10% that have the resiliency and durability to get through these tumultuous times.
Yeah, and lest anyone think because of our recent conversations that you're a tech specialist, far from it. These names have kind of fallen into your lap as you're looking across the markets for value and growth. You've got some financials in here. You've got Capital One and U.S. Bank. You've got some healthcare names, Humana and CVS. Let me just take a step back, Chris, and ask, what do you think is going on with the market here? And do you need to have kind of a grand theory of everything? Or are you kind of just keeping your head down and looking for stock-by-stock opportunities?
Well, I think the grand theory you have to have is that we came into this year with three massive transitions happening at the same time. So you had a transition from a decade or almost 15 years of free money, zero interest rates, magical thinking, modern monetary theory, deficits don't matter, money is free, valuations, endless liquidity. So you have a transition from that to a normal interest rate environment. You have a transition in 30 or 40 years of globalization into deglobalization, rising nationalism, geopolitical force. And then you have this massive transition happening because of the advent of this incredible technology in AI. So you have three big areas of transition. And then on the other side, you had transition married to complacency. You had the market at very high valuations, very high concentrations. You had growth. I would look at these growth assumptions that went into these sell-side models on some of the tech darlings that were assuming 20% earnings growth for a decade, 50% EBIT margins for a decade. Do you want a number, Kelly, that's amazing? How many companies are able to maintain a 50% EBIT margin for a decade, 0.1%?
Wow.
How about 20% revenue growth for a decade? Well, about 5 to 7%. So, people were just had this enormous complacency coupled with transition, all these economic transitions. That's a dangerous combination. And I think it set us up for the environment we're in, where I can't predict what the market's going to do, but I can tell you selectivity, the opportunity to buy durable, resilient businesses at 13, 14 times earnings and ride through this. This is a wonderful environment for a stock picker, and I think a great environment for this transition from this momentum index model to active management. I think that's why you're seeing the growth in some of these actively managed ETFs and things like that. You're beginning to see people getting in front of that move away from the index.